This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Hello. The Accounting Standard on Revenue sets out the 5-stage recognition model, but then there are a series of application notes which explain what would happen in specific situations. So I've picked these up here, but as long as you understand the model, you don't need to worry about learning lots of points for each of these situations. I think you really just need to be able to recognize the jargon and then use the revenue recognition model and your common sense to get to a situation. So some of them are more obvious than others. The first one I've listed is principal v agent, which I'm sure you're familiar with. So this is where you buy, for example, you buy a flight from a travel agent. So you go into town, you go online, you purchase the flight. You would be very surprised, wouldn't you, if you found that the person from the travel agent was sat at the front of the aeroplane with a pilot's cap on and a how to fly book on his or her lap. So in that case, of course, the travel agent is acting purely as an agent. So therefore, they would only show commission again in respect of their income. They wouldn't show the total cost of the flight. So the key thing, isn't it, is to think about who's responsible providing the goods and services. When I book a flight from a travel agent, it's still the airline that will be responsible for taking me from place A to place B. The next one I've picked up is a repurchase agreement. So it could be that something like a fish company sells fish to a bank. So here we are. I'll say a fish company, I'll put CO for company, sells fish to a bank. Do we think that the bank manager is having fish for tea? Is that the reason they've bought 3 tons of cod and haddock? No. It's simply, isn't it, a way of securing your debt. So it's a debt secured by fish, if you like. So if later on you're going to buy back the fish, if that's the substance of the transaction, this is not a situation where you book revenue. It's simply a loan secured on your working capital. The fish, of course, does not enter the bank. Very similar to a repurchase agreement is consignment stock. It works really, it's the same sort of idea. And this is widely used in the motor trade. So this is where a particular car company transfers assets to a retailer. Now I mustn't do any advertising, but I'll put one down. I'll put a car manufacturer down. So Volvo transfers cars to a retailer. So Volvo, who manufacture the cars, transfer 50 to a retailer in a particular town. The question is, has the retailer bought those cars yet? And it depends on all sorts of things, because often the goods are on sale or return. So if the retailer can't sell them, they return them to Volvo. So should Volvo be booking a sale? It depends on what the rights of return happen to be. So really, we always have to think about words like risk and reward. For example, who is it that takes responsibility again for things like insurance cover, risk of damage, obsolescence again if the cars can't be sold? Can we send them back? If so, then perhaps we never actually bought them, perhaps they never sold them. So it's a bit similar to the last one. Particularly in long-term contracts, contracts get changed. So perhaps I'm a plumber and I've agreed to install a bathroom, and then the customer says, well, could you also do my kitchen? Well, is that a change to the original contract, or is it a new contract? If it's a change to the original contract, of course, that means you have to think about splitting up the consideration for the original contract into the new and the old components of the deal. So the thing that we look at with modifications is if the plumber is now going to do my kitchen as well as my bathroom, I'm going to pay her extra money. Is it the normal selling price of a kitchen? In which case, it's a separate contract. If it's a specially discounted price, then perhaps we have to consider this contract alongside the other one, and we might have to say, well, actually, it's not a new contract, it's simply changing the earlier one. So the key word is, look at the price. Are they charging us the standalone price, in which case it's a separate contract, or are they charging us something less, in which case perhaps it is just a change to the original contract? With all of this, of course, you set out your argument. Your answer may not be the same as the examiner. Will it be wrong? No. They just want to see that you're able to have an argument about these things and you're aware of the standalone selling price rule. Sometimes, if you're buying someone a birthday present from a shop, the shop will say, if your friend doesn't like the present, then actually you can bring it back within a month. So they'll often give us sale with a right to return the goods. Question, well, I could take the goods back. The shop doesn't yet know. Can they book the sale? Now you have to be realistic, because if the shop gives all its customers 30 days to return the goods, you can't say we will book no sales for 30 days. That would be silly. What you'd have to do, isn't it, is make an estimate about how many goods you think will be returned. So it could be, from past experience, you think that 10% of goods will be returned. If that's the case, those should not yet be recorded as sales. So in respect of that 10%, the customer has paid. I don't credit revenue. I'll credit, well, what people used to call deferred income. I think probably a safer word now is contract liability. So here we are. We should see something here. If a return is likely, no revenue should be recognised. The sale proceeds would be credited to a contract liability account. Next one that I've indicated, easy one this, is an upfront fee you sometimes pay if you get broadband, some streaming service or something like that, or sometimes you go to the gym. Perhaps at the gym they say you've got to pay a joining fee of $50. Now, is that a performance obligation or just a way of ripping you off? It's often the latter, isn't it? The performance obligation is actually the fact you can get in the gym every day. So actually, the upfront fee may not be a separate performance obligation. So again, the gym should not be taking that revenue. straight away, but over the period of the contract. The final one that I've highlighted is warranties. And people often get into a muddle about this, so this is important. If you actually, again, go and buy a car, the seller will often say you've got 3 months, 6 months, or a year to bring it back. If it breaks, or 1 month, or anything, there's often a warranty included in the price. Now, realistically, if you go to buy a car, you can't say to the dealer, well, what's the price without the warranty? They just don't do it. So you get the price and the warranty, or go and shop somewhere else. They'll just tell you to leave the premises. So sometimes you get the warranty, it's all in, it can't be separated. In that case, there's only a single performance obligation. And the single performance obligation is car with warranty. End of story. So how do you account for that? Well, you can book the full amount of revenue now. What the dealer must do, though, is think about the fact you might break down, in which case they might have to come out and repair your car. So that is where you enter the world of provisions. So in that case, the yellow case that I've highlighted in yellow, they'll be debiting cash, crediting revenue, and debiting P&L credit provision with the amount of the cost they expect to incur in fixing your car. Sometimes, though, they might offer an extended warranty, and so they might say, well, you can have a warranty for an extra 2 years for $100. That is a separate performance obligation. So that would be recognised over 2 years. And normally provisions would not then be relevant. All you'd do is recognise it over the term of the warranty. I'd recommend you listen to this lecture again, because there was quite a lot in there, wasn't it? If you listen to it a couple of times, though, then these are some of the situations that we might see when we're doing our question practice. As I said, as long as you keep the basics of the revenue recognition model in your mind and use words like substance over form in the exam, you should be fine. Thank you.